is an interview we've been waiting for a long time now. I'm now joined by Ken Rogoff, Professor of Economics at the Harvard University, and he joins us on the line to comment not just on this week's jobs data, but how he's viewing the data that we've seen in the last few weeks and what his assessment is on whether the U.S. is headed for another recession or not. Professor Rogoff, thank you very much for your patience. You may have had to hold on to the line for a few minutes as we analyze the Fitch downgrade, but I'd like your commentary on what you make of the jobs data that came in today.
Well, it could have been worse. As you said, it was marginally better than we're expecting, and frankly, I had worried it might be something really awful and really shaken confidence at a time when it's already pretty fragile. I think it shows that the recovery, such as it is, continues to be very, very weak. Frankly, I don't think we ever left the recession in 2008. Carmen Reinhart and I call this the second great contraction. Output's not where it started at the beginning. Output per capita is nowhere near it. Employment obviously isn't. It's a very, very slow recovery, and I think it's sort of 50-50 of whether it gets worse.
Professor Rogoff, I know that in your work with Carmen Reinhart, you've pointed out that this is going to be a more protracted downturn, and therefore it's very difficult to draw conclusions from the constant weekly, monthly data that we see. But do you see cumulatively the housing data, the jobs data that we saw today, all pointing towards a marginal improvement of sorts that should help put us back on track for better expectations from the second half?
I don't think so. I think we're still in a very shaky situation where the base case is very moderate growth, decent growth, but the downside risks are still huge. The European situation's a mess. I think it has to get worse before it gets better. And so the risks are unusually tilted to the downside. If Europe can sort of pull it together, then we could see things really shaping up, the color, the tenor of the markets and of the economy. But right now it's hanging sideways, and the risks are really a bit worrisome.
Given that this is going to be a protracted downturn for the U.S., do you like what you see in terms of the political solutions that are on the table, given again that there is very little room for both monetary and fiscal stimuli of any sort? So I'm referring to, let's say, the jobs bill, even though it doesn't have all-round political backing. Or would you have expected politicians to come up with more interesting solutions to the problem facing them?
Well, I'm afraid we're in an election year. We're headed into the election in 2012, and I expect to see paralysis. We have this super committee meeting on the debt, trying to solve that. I think they're very energized, but I don't think that Congress, one way or the other, will back them, even if they do reach a compromise. Maybe the Republicans will go along with the president's suggestion of extending the payroll tax cuts, which are the biggest part of his bill, really. That might happen, but it's a very poisoned atmosphere at the moment, and you worry they won't do anything. I think that's been a piece of why things haven't picked up more, why it's been even worse than the baseline case.
So is it down now only to the Fed Reserve to in fact step in some fashion? Do you think they have room to step in?
The Fed has a lot of room to step in. The Fed could be much more aggressive than it has been. It, too, is somewhat paralyzed by the political process. One of the leading Republican contenders likened quantitative easing to treason, and some of the Republican leaders have lobbied Bernanke not to juice up the economy during the election year. But my goodness, with things so risky, the least of our problems is to have a bit of inflation at the moment. I actually think it would be helpful. I think the Fed could do something. I think the ECB probably could loosen its monetary policy. I was surprised it didn't.
I know you've made the case for a little more inflation, and I know that there are economists on the other side of that argument as well who believe that it's very difficult, in fact, to control inflation to mean just a little more and not substantially. But I won't get into that academic argument because it is a much bigger argument. What do you expect to see in the U.S. over the course of the next 6 months, both in the case of economic data as well as how markets react to that data? Because ultimately markets are a barometer of sentiment, and they will to some degree determine whether corporations sitting on large amounts of cash in the U.S. will start putting money back to work.
a lot of business people in the U.S. just say their sales aren't growing very fast, and they're seeing 1 or 2% sales growth. They could buy an iPad instead of hire more workers, and that's what they're doing. That's what you're seeing in the job numbers. And I don't think that dynamic's going to change anytime soon. As I said, I think we're likely to have moderate growth, the sort of 1 or 2%. Very unlikely that it's going to be tons better than that, and some chance, if Europe goes for the worst, that it could be bad. I mean, I sort of think the most likely scenario is this modest growth. Maybe sometime next year, if Europe stabilizes, sentiment will pick up. Maybe Congress will pass some kind of tax cut. Maybe the Fed in 2012, exasperated, will do something despite the Republican pressures. But it's still a very shaky situation.
Yes, that is many maybes. Let me come to your assessment of what's going on in Europe. I know you were at the IMF meetings and the World Bank meetings just a few weekends ago. What do you make of the situation in Europe? This week, at least, the markets seem to have responded positively to some degree of reconciliation that's coming through both on the recapitalization of banks across Europe and the need to urgently move forward with some form of bailout for Greece. This is the last tranche that is pending from the first bailout, as well as helping Greece, in fact, come back on track with growth. What do you make of everything you hear out of Europe?
Well, markets seem to be overjoyed every time they find out the world's not ending today in Europe. So it doesn't take much to make them happy. They're so scared. I think the Europeans have certainly, become more energized and moving towards something bigger, but I think they're still nowhere near the end of this. I suspect they're coming close, actually, to cutting the cord on Greece, not so much rescuing it and then trying to protect everybody else. But Portugal has problems. Ireland has problems. Certainly a lot of the Spanish municipals have problems. You have to draw a line in the sand, but it has to be in a realistic place, and they just haven't gotten there yet. And their political system, it requires unanimity on so many decisions, makes it hard also. So I think markets actually will hear news which cheers them for a month or two, but it's still a long way from the end there.
All right, you said that you think Europe's coming closer to cutting the cord on Greece. Now, it could be an orderly default, it could be a disorderly default. Do you think Europe is going to get worse before it gets better, or do you think it's going to muddle along for the next 6-8 months before it finds a solution to break out of this deadlock?
No, it's not going to find a solution to break out of the deadlock until things get much worse. That's the unfortunate reality. If you live in Germany, things just aren't that bad yet, and the Chancellor just doesn't have the political power to take the dramatic steps towards a fiscal union that they really need to take. So I'm afraid, it's still a ways off, the solution in Europe, which is not to say there won't be moments of cheer for markets as they get thrown a bone here and there.
Are you in favor of an orderly default with regards to Greece, or do you believe that it's very difficult to visualize what the outcome could be, just like we couldn't quite visualize what Lehman would do to us?
Well, there isn't going to be an orderly default for Greece, but the rest of Europe has to be protected when it happens. They have to decide what they're going to do. And frankly, I think if they'd done it a year ago, it would have been a lot easier. We wouldn't have quickly had the problem spread to Italy the way that it has. They need to really have a firewall, and they need to decide where to place it. And all those pieces need to be decided and in place as Greece goes. Greece default is just a matter of semantics. They're not repaying money now, and nobody seriously believes they're going to. The question's when they're just going to pull the plug on the whole thing.
How do you assess the chances of a contagion, sir? This is my last question to you.
Oh, there'll 100% be contagion, but the Europeans need to back the other countries. They have to stop a cascade of bank runs in Italy and Spain, and if they do that, then it'll be manageable.
All right, Professor Rogoff, I appreciate you finding the time to speak with us this Friday morning for you and Friday night for us.